and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on yet another new edition of The Big C. I'm Manisha Gupta, and with me is Nigel D'Souza, back with your daily dose of commodities, cryptos, and currencies. Hi, Nigel.
Well, hi, Manisha. And in just a bit from now, we'll be joined by, a couple of big guests on Big C. We'll have senior commodities analyst who'll be joining in on the show. That's Olga who'll be joining in. And also later on, we'll be having an economist who'll be joining in, to help us out with some analysis. So plenty to talk about on the show. Well, a quick check on the equity markets. Though overnight you had the Dow as well as the S&P 500, there was a bit of a mixed close that we saw on Wall Street. So there was some kind of nervousness out there. The Dow, as we can see, that ended with a cut of around 225 points. The S&P 500 ended more or less flattish, while the Nasdaq, well, that was the one that did a relative outperformance, ending with a gain of around 0.4%. The problem is what's going to happen with regard to Trump's tariffs, the implementation, and also uncertainty that's existing in the globe as well. So that's the big talking point, Manisha. Trump's tariffs, his tantrums taking center stage.
Oh, well, absolutely. It's the reciprocal tariff that really have taken effect at the midnight on Thursday, with some of the steepest duties, including Syria's 47% and 40% rate facing Laos and Myanmar there. But shifting focus also to Asia-Pacific stocks, and largely in the red on your screen, but the Japanese stocks rose sharply, with the Nikkei up nearly 2%. Back home on the Wall Street, the Nifty hovering near day's low. A rather tumultuous week for India after Trump announced a very hefty 50% therein. But shifting focus now to the crude oil markets, and the prices are headed for their steepest weekly loss since the date June, as investors expressed concerns over the impact to the global economy from tariffs that kicked into effect from Thursday. The Brent crude prices are on track to decline more than 4% this week on over week, and the WTI is down by nearly 5% on a weekly basis. We are looking at a one-month lows in case of crude oil prices in the day-to-day. Olga Savina is senior commodity analyst at BMI and joins us now with her sense on all of that space. Olga, hi. Thank you so much for your time today. I want to start with the crude oil prices first, and they have been very, very volatile. On one side, there are now expectations that the U.S. and the Russian presidents will meet in the days to come, and that perhaps has eased some tension. Otherwise, we've been talking about those sanctions and secondary sanctions, and India clearly has been a recipient of 25% penalty because of crude oil buying from Russia. What is your sense on what the crude oil will look at forth now?
Thank you. Good afternoon. I would like to reiterate a bit on the metals prices that are reacting as well. And most importantly, I would like to touch on copper slightly. As the commodities markets are largely influenced by the Trump tariff shocks, and as well as does the metals markets, and most importantly, copper markets, we at BMI have long highlighted that tariff threats would remain a focal point for metals, especially for copper, with the metal expected to feel the brunt of the trade turmoil impact the most out of all metals. And this is playing out now. Speaking a bit on copper prices movements, earlier this year, copper prices started the year on a strong note, and were first marked as Trump's next target for sectoral tariffs in late February, and were at an upward trend till the late March. But that's April brought a sharp reversal in sentiment, with copper reaching a year-to-date low due to concerns of a broad deceleration in major markets. And the copper was hit by another shockwave in early July, when Trump announced a 50% tariffs on copper imports. And once again, in late July, when the president imposed a 50% tariff on imports of semi-finished copper and derivative products, scaling back from the previous anticipated sweeping tariffs on the red metal. And the move saw US copper prices wiping out earlier gains and plunging significantly. So we do expect significant volatility to be the driver for copper prices, for metals prices looking ahead.
All right. Hi, Olga. Good to see you, and thanks a lot for joining in on the show. Give us a couple of levels, though. As you said, copper has seen a sharp correction from the recent peak. Where do you see it headed?
So now we see that downside pressures are building for US copper prices that gained a lot earlier this year. And we see that the premium over the LME prices, the difference between the US and LME prices is collapsing, and the market is approaching the previous parity. As of the beginning of August, as of now, the copper market continues to digest the tariff surprise last week. We also note emerging signs of the LME copper stocks heading higher. We do highlight that Trump's move is likely to further roil the global copper trade flows, keeping the markets on edge, at least in the short term. And this excess supply in the US that was building up might be cleared out soon. And these will fuel in downward pressure on international benchmark copper prices looking forward.
Olga, it has been a very volatile year for copper to begin with whether or not and when those tariffs will come. And when they've come, it's been 50%. And we've seen a price roller coaster ride as well coming into the markets there. Would you say there is going to be more stability as we move ahead from here? And as Nigel was pushing for a number, really, are we done with the correction on either side? Would you look at more consolidation from here? And whether it is on LME or COMEX, what price range would you be working with?
Stability probably is not a center topic this year. We expect, but at the same time, there are some positive news. We expect copper market sentiment to tilt more towards fundamental, shifting a bit away from the tariff sentiment. When I'm talking about sectoral tariff threat sentiments, and we expect copper prices to be underpinned by two dominant forces over the coming months, I would say. Although we do highlight that undoubtedly other factors might come into play. But speaking about these two major forces, these are definitely Chinese demand, which has remained relatively sluggish so far this year, and the trajectory of Fed policy and US dollar movements. For now, we're sticking to our forecast for copper prices at 9,500 US dollars per ton. But at the same time, to revert a bit back to the sectoral tariff threats, while the risk of tariffs has currently subsided, and we do expect the market to follow more the demand side factors at this time, I would say, scope for further tariffs on the red metal remains, with the Secretary of Commerce required to provide an update on the domestic copper market by mid-year next year to determine whether to implement a universal duty on refined copper. But speaking about our outlook for copper prices over the coming months, once again, our outlook is leaning towards a neutral to slightly bearish stance, and a tepid Chinese demand and a slower global growth outlook for 2025 overall, with downside risks to the global economy remain elevated.
Olga, since we're talking metals, and if you follow gold, and the way we do understand now that until now the markets believe that, well, yes, you have tariffs on steel and aluminum and copper, but perhaps not on gold. But the latest data and various reports now suggest that since nearly 60 to 70% of gold that U.S. imports from Switzerland also could come under that 39% tariff. And we did see overnight gold prices react on a very, very stronger note. The COMEX gold prices ran up. They are still up $100 an ounce, and sense of premium to the London prices. How are you reading into this? I mean, gold is a raw material. A lot of people thought this would be exempted. It hasn't.
Gold had a super volatile year as well, but gold is clearly an outperformer across the metals complex, because gold thrives on safe haven demand, reaching a high of $3,500 per ton in April on the Trump tariff threats. So yeah, we do expect gold to be volatile this year, as we also expect volatility across the copper market and the metals market, as the global trade environment remains super fluid and remains volatile as well.
And from the precious metals, what is your preference? Because silver did do a bit of a catch-up. Now it's consolidating a little bit. We have platinum as well that's moved a goodish bit. So from that basket, what do you like?
I would say that Now, once again, gold remains an outperformer across the wider Miles complex. Called gold typically thrives in the time of uncertainty, in the times of global trade uncertainty, where we are now. So gold will benefit once again from trade tensions, from geopolitical tensions across the world, and will remain the outperformer.
Olga, would you expect the gold prices to make further higher highs, or do you think 3,500 is where we could be looking at some resistance? Because a lot of reports still suggest 3,600 and 3,800 and even $4,000 an ounce by next year.
This also depends a lot on the US Fed's policy and the US dollar movements. So we are now still expecting the Fed to cut this year, but again, it has to be seen where the Fed's policy will land, the policy rates by the end of the year. So this will also shape the gold price movements going forward.
A lot of people have been bullish on silver as well, what with the fifth year of deficit and, of course, strong industrial demand. Tariffs, of course, is something that seems to be denting that euphoria a bit. But how are you looking at silver as an investment from here on?
Precious metals, including but not limited to gold, again, are benefiting from global trade tensions and global trade uncertainty, and we remain we maintain a positive outlook for gold, looking forward for precious metals.
All right. I also wanted to ask you about aluminum, because you had alumina prices that had been fairly volatile. Not sure whether you track that one, but, what's the outlook on that front?
Yeah, again, as I mentioned before, industrial metals had a volatile year, and aluminium faced tariffs as well, though the sectoral tariff threat for aluminium was probably a bit more pronounced if we try to compare that to copper, if it's possible to do such a comparison. But, for example, copper market reacted. Copper market felt the brunt of the tariff impact the most out of all metals, I would say. So yeah.
All right. Olga, going forward from here with the kind of uncertainty we are dealing with, would you say demand supply would come into picture? Is it going to be more macro on how the US tariffs move, how the dollar index does, and how are the reciprocal tariffs and how other countries behave? What is it going to be? Individual fundamentals vis-a-vis this global macros?
Yeah, exactly. We do expect the market sentiment, once again, if we're talking about the sectoral tariff concerns for metals. Of course, global tariff concerns remain with no doubt, but if we're talking on sectoral tariff concerns, we expect the market sentiment to tilt towards fundamentals, to tilt towards probably the demand side story, the demand picture this year. So looking, for example, at Chinese demand, which remains tepid this year, and the risks to global economy remain elevated. But for example, even China and US dollar side risks to the outlook, for example, to our copper outlook remain. For example, supply side concerns, which we are currently seeing in copper market, push prices higher should they emerge, reemerge. However, at the same time, as we're currently noticing, prices have largely, if we're talking about copper, have largely overlooked supply side risks so far. I'm talking about earlier this year. So at this point, if we're sticking to the copper market, I would say that demand-driven factors and any possible turnaround in demand, though unlikely as of now, especially given the fading hopes of Chinese stimulus, but demand side story might be more pronounced for copper at this time.
Well, that point is well taken. So clearly a lot of volatility expected in the international markets. And as Olga tells us, that copper, perhaps $9,500 a ton is what you could be looking at as in sense of targets there. Thank you so much for your time. I appreciate your time joining us with us today. But with that, it's time for a short breather on the show. On the other side, we'll be joined by Sumedha Dasgupta of Economist Intelligence Unit. Stay tuned. Welcome back. And Sumita Dasgupta is Senior Asia Analyst at Economist Intelligenic Unit. She joins us on the show now. Sumita, thank you so much for your time with us. First of all, on tariffs, really, because that is a conversation that is non-ending. And most of the experts believe that this perhaps could continue for the month of August, even September for that matter, with the way we are stuck with 25% and then plus 25%. What is your sense on how do you see, first of all, these numbers and the extent or the timeline to this?
Thank you so much for having me, first of all. Unfortunately, yes, this has been a shocking week, if not anything else. So I think with the 25% tariff rate that was there prior to when it became 50%, that was kind of baked into a lot of market forecasts. So that wasn't sort of extremely shocking, I would say, at that point. But yes, the developments that happened 2 days ago overnight, with 50%, it does seem that there is now an added angle of, should we say, belligerence in the trade talks that are happening between India and the US. In terms of timeline, it's of course very hard to call because initially the timeline when they started talking in February was September, October. But with the level of developments that have happened since then, it does seem that there is significantly a lot of other unknowns which have been thrown into the mix. So I would still think that in the next maybe 2 or 3 months, we could see some form of trade deal, mini trade deal, an early harvest form of trade deal, whatever you wish to call it, that kind of a thing. But there are still several areas, I would say, which are fairly complicated for discussion between the US and India. Possibly those will potentially be put on the back burner, and both countries will try to sort them out on a longer timeline because those kind of things really can't be done on a clock. So that would be the kind of timeline that I'm looking at. And obviously, if some form of trade deal does come, then we are not at the 50% level anymore. But the time for this is sort of anybody's guess. Until then, obviously, it's very, very adverse for India at that point.
Hi, Sumita. Good to see you. A couple of quick questions there. What do you think is the end game with regard to this? Because India as well is not backing down. We need to, protect the farmers. So we are unlikely to back down on that front. So what do you think? We bend a little bit, maybe not consume so much of oil from Russia, divert some part of that to the United States, maybe in defense equipment as well, buy some defense equipment from the United States. That could satisfy Mr. Trump and that we have lower tariffs. Do you think that would be a logical solution?
Well, I think a lot of the answers are already there in your questions. So it's very ironic, actually. The 50% tariff or the additional 25%, whatever you wish to call it, the penalty rate, is actually, it really does not have anything to do with the Russia-Ukraine war per se, or even India's imports of Russian crude oil. It actually is a negotiating tactic because Mr. Trump, as a businessman, feels that if there is undue pressure put on somebody who is negotiating with him across the table, then that person is just that much more amenable to agree to all his terms. So that may have kind of actually stood him in good stead earlier. It's also stood him in very good stead with the Southeast Asian countries, which have taken any kind of trade deal that they have got. So that's, in fact, to the extent that we may not even call them trade deals. India has shown actually surprising resilience, and this is something that has forced Mr. Trump to kind of do this because he feels that this is a tactic to bend India. I very, very strongly feel India is definitely not going to cut down on its Russian energy imports. It may, of course, step up US energy imports. Is anyway something that was in the talks. So LNG imports, for example, could be stepped up significantly. But I think that India, obviously, in terms of its energy priorities and in ensuring that there's not an inflation subsidy balance of payment spiral, will continue to prioritize Russian oil supplies. That's certainly going to happen. Other areas, of course, India may bend a little bit. In terms of defense, actually, there is significant diversification already happening. This is a trend that's been happening for the past couple of years. India has cut down on Russian imports significantly. It has prioritized the USA, prioritized France. That is a trend that's going to continue. So that's actually not something where India needs to kind of change its tactic. And in terms of agricultural market access, I still think it is a hard no for India. This is a very, very sort of significant political minefield. Anybody knows in India that this is something that you can't give into. India has fiercely protected these sectors, even in other trade agreements. Opening it up to one will mean that you will need to kind of make other concessions to other trading partners as well. So that I would still say is a strong no.
So, Medha, also just given, for the sake of understanding, 25% tariff is what India is dealing with right now, already implemented, 50% on 21st of August. At 25, what is it that the damage India sees on its GDP numbers? And at 50%, what that number comes to be?
So at 25%, actually, my forecast at EIU was already at around 6.2%. So if you remember, the original tariff rate was anyway 26%. So it's nearly the same. So the GDP growth would be around maybe 6.2%. Very important things to remember. Obviously, India is a fairly insular economy, depends very much on internal demand. It is not as exposed to trade as Southeast Asia or China, does not depend on exports as a growth engine to that extent, which obviously in these times serves India much better. If we say that the 50% number, which kicks in at the end of this month, as you said, stays on, say, for the rest of this year, in that circumstance, I would definitely see a further shave off in the GDP growth number. It would potentially come down to a little below 6%, so around 5.8, 5.9 would be the number that we look at. That is still technically actually quite strong and healthy for a large economy. India is a major economy, so that kind of growth rate wouldn't really be a tremendous hit. But yes, it is true that this would definitely be much lower than what we could potentially have had without this tariff conundrum. So those would be my numbers.
All right. What do you think, looking inward, what can India do? Monetary policy, we have seen some action. The RBI has gone in there. They have cut rates a couple of times. The last time they spoke, though, the RBI governor sounded a tad bit towards the hawkish side, which disappointed the equity markets as well. But do you think we have some more in terms of monetary easing out here? My guess is that maybe, in fact, we wait to hear what the Fed does, and then maybe, in fact, the RBI tries to pepper the economy. And on the fiscal side, do you think that, maybe some rate cuts, they've already going to be some, the taxes that have been skewed and will help mid to lower class, that will push some money into the hands. And that what could help consumption from September and October. Do you think we have some kind of leeway on the fiscal side as well?
Well, I wouldn't say so much on the fiscal. It is very much committed to fiscal consolidation. They've sort of stayed on that path, and giving kind of a fiscal dole or a handout would be a conversation only if the government is absolutely sure that this 50% is kind of there to stay. In terms of monetary policy, I certainly think that there is room for further easing. There was a pause this time, yes, but I do think that the last quarter of this year, calendar year, is going to see another rate cut, especially the RBI will also be very vigilant on looking at the new tariff regime that has come just a day after the monetary policy, the new announcement of 50%. So again, there is room over there for some action to happen. Even if the tariff does get rolled back, say back to 25%, still that is significantly high, and the RBI will want to take some kind of action. So definitely on the monetary front, I would say something would be upcoming, not so much perhaps on the fiscal front right now.
All right. Well, we take that words cautiously, of course. And as you said, expectations are that 25% perhaps could stick, 50% not so much. And India wouldn't really be able to work with that kind of a number as well. So, Medha, thank you so much for joining in and making sense of what the tariffs and what really India could do going forward there. But with that, it's wrap on this episode of Big C. Thank you for watching.